A lot of LPs want to look at just the financials, and they want to say this returns 12%. This has this data point. And the person behind the deal, really what's going to make or break.
What's up, guys? It's Ron from Ronald Law. And today I'm super excited to have Mike Neubauer with us today. He is the general partner and CEO of Grand Visions. So we're going to walk through scenarios so that you learn what are red flags that every LP investor should be looking for on their next passive investment deal. So Mike, thanks for joining us.
Thanks for having me, Ron.
Tell us a little bit more about what are the stages of due diligence that an LP investor should be looking for things and either kill a deal or maybe they warrant an insider look. We'll call that like a yellow flag.
Yeah, I think the very first thing is just getting used to the fact that you're going to be sifting through a lot of these deals before you find a good one. I think a lot of people see one email pop up and it's got some big fancy numbers and they feel like I got to jump into this one. And I think the very first thing is just to expect that you're going to see a lot of these before you pull the trigger on one. And especially if you're new at it, it's going to take you a while to really get that feel. After you've done it for a while, I feel like it kind of becomes a little bit of an art of you can kind of tell right away. But honestly, to me, some of the big red flags right out of the gate are the big fancy terms and the multiples and the language that speaks in a way that seems confusing. Like off air, we had talked about, combined experience, or we expect, 2 to 3x multiple. Well, I mean, 2 to 3x is a huge difference. It's one or the other. And I realize some of that is marketing, but these are things to start to look at. Are we trying to pitch this more as a marketing play, or are we truly sharing the numbers of how we expect this deal to perform? So I think when that email first hits, that's the first thing is, how does this feel? Does this feel purposely marketed, or does this feel like this is real numbers and we need to kind of see and dive into it and take a look at it?
Well, that's a great point. And it's something that I have a lot of issue with. And I introduced it, but I hate the word passive investment. Okay. Investing in real estate is not passive. And even some of these LP deals, what happens is that you are front loading the work. You have to do 10 times the amount of due diligence and work upfront prior to your investment. After you make your investment, your work does decrease significantly. But the work is still there. You just have to front load it in the due diligence and vetting of the operator and vetting of the site and the business plan. But there's no such thing as passive real estate investment. You're either front loading the work or you're evenly distributing it across the lifetime of the investment. So that's my first caveat. Nothing is passive, but I'll add, basically, for every red flag that Mike's going to throw out, Ron's going to chime in with what are the legal documents, or what could you actually have a cause of action against a GP for stating. So in your first example, are emails part of the legal representations? I will say that yes, every sponsor should have their lawyer review each email before it goes out for inaccurate statements. So they can be used and they will be admitted in a lawsuit against the GP. So that's the step number one. But number two, there are a lot of disclaimers that mitigate the impacts of that marketing. So it's a little bit of a double-edged sword, but if people are putting blatantly misrepresented facts in an email, that is a red flag.
Yeah, I think a lot of times it's to get an email open rate, and to try to. And the problem that I see a lot is these emails are not coming necessarily from a GP. They technically are, but it's somebody on the GP team whose job is to raise capital. Their job is not to run the deal. They're brought in on the team to get people to come and sign up. It could be somebody who's well connected with a lot of money. It could be somebody who's just very good at marketing. So a lot of times that initial contact is not necessarily the operations person behind the scenes. That person who really knows how to analyze a deal and run the deal is not always the same person who's sending that email or making that initial contact, with you. So I think that's kind of important as well, is get that initial feel and then just verify, am I talking to the person who's actually calling the shots on the operations of this thing? Or am I talking to the person who's just raising the money? Because if you're talking to the wrong person, it doesn't matter how good your questions are, you're not going to get the answers that really mean something.
Right. So I'll consider that red flag number two, which is who are the people sponsoring the deal? And this is a very easy legal link up, because when I see more than about 3 or 4 key principals or GPs with the bios, because in every pitch deck and your OMs and all that stuff, you're offering memorandum, you will have bios for those GP principals. And if the person you're talking to doesn't make the cut or is very far down the list as number 6 or 7, and he's got a 2 or 3 line description, they are most likely just brought in as a 1% or 0.1% GP, and they're getting compensated on money raised, which is definitely a red flag. Is if you have members of the GP who are solely being brought on to raise money, that's definitely a red flag from my perspective.
Yeah. And I think once you get to that point, then now you're ready to start, asking questions and you get a feel. So I think the very first thing is what I like to do is I like to see the pro forma, especially if it's a listed property, came from a broker, they put together a fancy pro forma. I like to see the pro forma, and I like to see the GP's expectation, their own personal due diligence and the underwriting, and basically compare those side to side, because sometimes if those match too closely, I mean, we just know from running deals that very rarely does the broker pro forma match our expectations. So when I see somebody else where the broker pro forma matches the underwriting of the GP, it's kind of a red flag for me that there wasn't a lot of effort put into this. It was just, changed slightly in order to say that it came from us. And that kind of throws a red flag, because very rarely does that match
Great.
up.
I love it. Really simple rule, which is red flag number 3. How closely does the sponsor pro forma match the broker or listing agent's pro forma? Again, legally, whatever they provide you in writing is their representations. So if they make statements about expenses or rent increases, again, I don't know that it's actionable, but it absolutely would be included as part of this, the GP representations to you when they send you that model. Question, do you ask for the models in Excel format, or are you okay just with a PDF?
It really depends. I mean, if they have the Excel, it's a lot easier to run numbers and makes it much simpler. But if it's in PDF, still we're basically kind of at high level. So a PDF is fine to give a quick look at, the numbers on the income, the expenses. Do things match up? Are they looking similar? If we're going to get to really dive into this deal and make a decision, okay, not necessarily are we going to continue due diligence, but are we actually going to pull the trigger on putting money into this deal? Then we probably want to see it in an Excel, and we're going to take a deeper dive into the details and run some calculations to make sure everything seems to be adding up.
Got it. Okay. So let's say you've gotten past the email blast. Let's say you've gotten past the pro forma. The sponsors all seem to check out. What's your next red flag, maybe on a property level, or what?
Yeah, I mean, at that point, it's really looking at the amount of money they have into it. And I shouldn't necessarily say the amount of money, because the amount of money is relative, but how much skin they have in the game. So if this thing goes sideways, how much do they have to lose? Because if I put $2 million into a deal and I lose it, it's going to hurt. But if Warren Buffett puts $2 million into a deal relative to how much he has, that's not going to hurt. So I'm kind of looking at how painful will this be on you if this doesn't work? So are you signing a personal guarantee on this? Are you putting your own money into this? Do you have family or close friends who are putting money into this? How much are you putting at risk alongside with my money when I put my money at risk is kind of the next thing. And that's kind of a dance of nicely asking those questions. Because if you come across with just an email that says, how committed are you? How much skin do you have in the game?
What percentage of your liquid net worth are you putting into this deal? I agree. That can come across like, next, I'm going to cancel.
Exactly. It's an art of getting the answers to your questions without offending somebody, right?
Absolutely. So I think that's a great question, because what I typically see when we review the docs is somebody will tell me a great number that, hey, the GP, this guy personally is putting in, 300,000 and this other guy's putting in 200,000. And I say, aha, but when you net out his very high acquisition fees, he's got different legal fees, he's got due diligence, marketing, tons of origination and other fees that don't necessarily equal outflow. So for example, I see it, they may have a loan origination fee of 1%, but they're only paying their lender 0.5 point. And they say reasonably, well, we're doing due diligence to apply for the loan and we've got to, send out all the documents. So we're going to charge 0.5 point for us to do the work and only 0.5 point to the lender. Totally okay in isolation. But if he also has a 2% AC fee, that's starting to raise red flags, because what we do is look at what is the sum total of all the fees that the GP is pulling out relative, and subtract that from his big, $500,000 commit. He might only be putting in $150,000 at the end of the day after he nets out his fees. And you have to be very careful about which fees are solely passed through, or he might net some delta, especially on a loan, where there's a large loan amount. Half a point is significant. So
yeah, it can add up. I like to look also are these fees going to be on the front end before you perform, or are they coming on the back end? So if we're talking about loan origination up front, I might be more hesitant on that fee. But if we're talking about a performance on a refinance and we're going to get paid on the refinance, especially maybe based on how likely it is or how close we are to hitting the actual numbers that we promised, well, if the fees getting paid based on performance, I'm more comfortable with that. But if the fees are getting paid no matter what on day one when this thing closes, that raises a red flag for me on why are we front loading all of this money, and we're kind of misaligning our interests, right? My interests are in the long-term performance. Your interests are in getting this thing closed on day one. That's not really setting it up for future success, because you make more money the more deals you close and the more people you get in here. You don't make money by performing on your deals. You'll ruin reputation, but the money is coming up front. So you want to make sure that the performance goals align, that when I make money, you make money.
All right. So I think that's great. I think we'll summarize red flag number, are we 3 or 4?
Yeah, I don't know.
GP contributions as a percentage net of day one fees. So, and again, just to be clear to all the GPs listening, it is reasonable to take some fees. Okay. We know that you have overhead, you have chase costs. There are very real costs that you need to recover. But what does it look like on balance? And is there a preference or a weighting towards disposition fees where you might get a higher 2 or 3% of a dispo or a refinancing to incentivize performance? That's what you're saying is a red flag, is front loading fees relative to the initial capital and then not weighting towards a heavier dispo or refinance.
Yeah, exactly.
Perfect. All right. So let's say that the fees all check out. You run through the origination. He's got a 1% AC fee. He's got a 2% dispo fee. Legal fee is straight at cost. All these things are making sense. What's another red flag, maybe on the property or location?
Yeah. I mean, it really comes down to, I would say the red flag is how much experience they have in that location. So we're all in the Midwest. We have a lot of experience in the Midwest, but if I bought something down, let's say in Florida on the coast, I don't have a lot of experience. So some of the operations are going to be the same, but a lot of the risks are going to be very different in a totally different geographic area. So that would be kind of the next thing, is just overall experience in the industry we're going to be looking at, but then also specific to this asset type and specific to this geographical area. Some things even like zoning and, politics in an area can drastically change the landscape of a deal. So the experience overall, I think, is the next red flag to kind of take a look at.
Well, let me ask you this then. How much do you value full candor or transparency if a pitch says where the weaknesses are of a deal? And by that, I mean saying these assumptions rely on, insurance premiums not raising more than 15%. And they're saying that property taxes and insurance increases pose the biggest cash flow and profitability of the whole project. Do you like 100% honesty, or would you rather just understand that everybody has that risk, so it seems unnecessary?
Yeah, I would say I like the transparency, but most importantly is the response is, that sounds great. How much experience do you have in dealing with this? On previous properties, have you seen the insurance shoot up? On the last property you closed, and a year later or 2 years later, how much did property taxes increase from what you expected them to increase? Were you spot on? Were you under? Were you over? And that's where that experience kind of in the local areas come, because some property taxes are reevaluated each year. Some are on a 3-4 year basis. Some they disclose the sales price, so the county knows right away. There's so many different variables, and that's where that experience comes in. Is last time you were in this area and purchased property, how closely did your projections match up to what actually showed up a year or 2 years later?
Great. I think that's perfect. And that's all a dovetail. And we'll maybe take this time to break, because when we're going through all these red flags, the point of this whole video is to educate people about the art versus science. And every red flag alone is not enough to kill a deal, because I think we talked about before, there will be hair, or there will be probably a red flag on every single deal. The question or the challenge for you as an investor is to decide what is a yellow flag that warrants caution, but you can still move forward. What is one red flag that you have to be aware of, but that's maybe the risk premium for the deal? And then how many red flags and what's the severity that kills a deal? And that really becomes an art, because you and I talked about, we look at so many emails and we looked at so many pitch books. We can get a flavor of, this is a thinly traded deal. It has cap rate compression assumptions. It has flat or 5% expense increases, very thin opportunity with a lot of downside risk with high debt or something. But we can get a sense of that. And the purpose of this video is to articulate what we are seeing when we skim through one of these deals, right? I mean, tell me, what art versus science, how do you think that should be balanced?
Yeah, 100%. And really what we're kind of talking about is how to ask these questions, because you maybe don't know the exact answer. You don't know what property taxes in Broward County, Florida are going to go, but you don't need to know the answer. You just need to know how to ask the question, because like we said, we kind of develop a skill of an art by doing it so often. If you haven't done it as often, you just need to know how to ask the right questions so you see how the response comes back to you, because that's the art of it. It's more human behavior art, is to say, hey, here's a tough question. Does that GP feel confident in the answer? And they say, yeah, I've done this, 3 times. Here's exactly what I've seen. Do they respond with confidence, or does that question throw them back on their heels? And now you know that they're kind of off track, which just gives your gut that feeling, right? Like you're starting to ask questions that your gut can start to analyze, not really the scientific data of it, because you may not have the scientific data as far as, knowing the exact NOI, the exact expenses in that area, but you're trying to give your brain as much information to make a good gut feeling on, are we going to dive into the numbers of this thing, or do I not trust the person who is presenting this to me? So it doesn't really matter to dive into the data yet.
No, I think that's another way to describe it too. Each of these red flag analysis is never to decide we're going to invest in this deal. Every red flag or decision making is just to get to the next data point. It's all just a sequential to get you to the next one. And only after you've completed your own internal process and you've asked all of these questions and gotten a lot of feedback from the sponsors, then you can make a cumulative. But none of these red flag issues are meant to be, okay, this is satisfied, we can invest. You have to run the whole process. And that's where it speaks to, your point about, you've got to look at a ton of deals. And the best investors that I have, really sparingly invest. And when they do commit, they really concentrate on the one deal, as opposed to spreading out a bunch of $50,000 investments. I would much rather put $250 into one deal that I feel 99% good about, versus spreading $250 across 5 deals that 2 of them go bad. I mean, the amount of work that goes into investing, committing to 5 deals is tremendous. So
yeah, 100%. I think it's a whole nother conversation, but by diversifying is also, oftentimes a fancy word, and it feels less risky, but it can be much more risky, because it kind of, you feel safe, so you don't do as much due diligence. You're better off diving super deep into due diligence, and when you find one that you really feel good about, to go heavy on that one versus spread it all out, because really, like you said, even if you have 3 winners out of that 5, the 2 that tank may pull everything down and trash that whole 250 investment. So I think it's important to do that due diligence and really get a good feel before the money gets put out, because the diversifying your money doesn't quite eliminate that risk. It just makes it feel like you are.
So new minimums from Mike and Grand Vision is 250 investment minimums. Everybody else, save your pennies. So another red flag before you actually pull the trigger: when you're engaging with them, do you want to know the other professionals they're working with? Because so far we've really just focused on the operator, but real estate is a team sport. what's a red flag when you look at some of their property management companies or who their lender is going to be?
Yeah, I want to touch on real quick too that 250, as an example. But also the other benefit you have is when you go deep with somebody and you give, instead of 50, you give 250. It opens you up to ask these questions a little bit better. They're more willing to respond to you when you have a big investment coming. Where if you're just dropping 50 and everybody else is doing 200, it's much less likely they're going to answer your question. So that's kind of another benefit of going deeper, is that you kind of rise yourself on the capital stack, and they're more willing to answer these hard questions than if you're only putting a little bit in. And then, so back to the question of the professionals. Yeah, I'll just go with that then.
Well, I was going to say too, if you're a bigger fish, I will see side letter agreements or preferential treatment if you're a bigger fish within the cap stack. So if they're raising $2 million and you're 250 of that, you may negotiate for things like a slice of the AC fee. You might negotiate to get a rebate or get a higher percentage of some of the other fees, and you just get a preferential financial treatment, not just the underwriting, but you can actually get legal, tangible dollars if you're a bigger amount and they need your money. So that's what we do for our clients that write bigger checks on fewer deals. So
yeah. Exactly. For the professionals, I'll tell you the easiest red flag. This is what I like to do. It really comes down to bookkeeping. So if I say, hey, why don't you shoot me over some of your financials on a property similar to this? Just give me a T3. What we're in January right now. So I mean, the December financials, bookkeeping wise, should be done. I'd say just let me get a T3 or let me get a T12. Let me get the 23 financials, and let me just take a quick peek at that to see how closely your projections on this deal match your performance on the last deal. And if you get an email back, within a couple hours with that T3 or T12 of their financials, it gives a pretty good feeling that, all right, these guys are pretty organized and dialed in. If they say it's going to be a while, I'm waiting on the bookkeeper, the accountant hasn't looked at it, a lot of these are delay tactics to basically, in other words, say we're not really organized enough to have these financials. So the bookkeeping and the up-to-date financials, to me, is kind of like the easiest red flag to take a look at and say, are these all the professionals on their side of things, are they pretty dialed in, and are they performing on a regular basis?
No, I think that's a great example. And I rarely see who the bookkeeper is listed. So in the OM, in the PPM, they do list the professionals that they work for. They'll list the securities law firm, they list the broker, if they're lender, if they're going agency, whatever, who their facilitator is. And maybe I see CPA, but I rarely see necessarily that bookkeeper element. When you touched on something that's really important, the scope of responses. Is it a red flag if they don't respond within a couple of hours for something simple versus what's a reasonable response time?
Obviously on the GP side, the quicker you send something, that it shows more proof that you're pretty organized. And, everybody gets busy. They could be on vacation. There's a million things that can happen. But more I'm looking for, if somebody sees the email and they respond with an excuse, or if they see the email and respond with an answer. So most people that are delayed in responding, they maybe didn't see that email. Most people, when you send an email and they read a question that they don't have the answer to, their gut tells them to respond with an excuse, delay this, because they've already read it and their conscience is kind of worried. So they want to respond to appease you, and they'll usually include an excuse. So it's not necessarily as much the time frame. If we start getting 2, 3, 4 days, I might follow up and say, hey, just want to make sure you saw this, and see what the response is. But it's more the content of the response versus the time that it takes to get that response.
Fascinating. Yeah, I really agree with that psychology of an answer versus no answer. And then to add some layers onto that, it depends on how big the GP is. Because if it's kind of just 2 or 3 guys that are doing this for a while and they don't necessarily have huge overhead of staff, versus if this is a large organization, they'll have IR, investor relations people, that their job is to respond. My expectations are very different if I'm emailing somebody who is, smaller operations versus somebody who has dedicated IR. My standards change, and I still think they'll do a good job, but other people get busy versus, they have a dedicated person. And I think the psychology would hold true, whether it's IR and he or she knows I don't have the T3 or I can't get it quickly. They're going to do that same thing, even though they're not the principal, versus a GP who, knows that they got to chase or they got to pay an invoice to them, and then they'll release the month's financials. I can't tell you how often that type of situation comes up is, there's a fee dispute. And so they're not going to release the last month's closed books. You just don't want to get invested, I think, in a situation where somebody is not able to provide a basic level of documentation. So maybe we'll go extreme then. What do you think is an example of a question that's too far, that if you got asked this question, you would say, this is a red flag from the LP. I'm not going to provide the wall thickness and the insulation rating in my laundry room because I don't know if it's R34 or not?
Yeah, that's a great question. So again, right, the more money you're putting in, the bigger the fish you are, the more likely we're going to open up a little bit more. But I'll tell you the one question that really upsets GPs. I love this question because I think it's totally fair. But if you ask for a GP, if you're really putting a lot of money and you're like, I need to double check and make sure, is to say, hey, could I see your last couple of years tax returns to see how well you've done this? And the GPs get very offended by this because they don't want to do that. But to me, and the reason I don't think it's so offensive is we're asking the sellers in our due diligence of the property, we're always asking for tax returns. We always want to see the past performance, because if they put down a pro forma as XYZ, but the tax return on that property showed otherwise, they're claiming much different income and expenses, then that's a huge red flag on the deal side of things. And on the GP side of things, like I said, they don't like to give that personal information. But to me, it seems very fair, and it's very much proof of you actually have been doing this for a while. You're not just talking about doing this. This shows real numbers. It shows multiple zeros, on the size of deals that you're doing. And it shows that you've actually run through a couple cycles. You've actually done this before. This isn't all theory. This is proven in the past.
You're asking about partnership returns, 1065 for a prior property level return.
Yeah, I would say, give me a past property or two. And if you could just shoot me over that partnership return and then also your T12 on it. So just see a little bit of experience on this of a similar property that you've done to see how close does this match up to what you're projecting on this property. Because if you've done it before and your expense ratio on the property you're currently running is 40% and you're projecting 40% here, I'm pretty confident that you're spot on. But if you're operating at 60% over here and you're trying to sell me that you're going to operate this one at 40, there better be a very good explanation of why. Are property taxes that much lower? Is insurance that much lower? Did you learn a ton from this deal that now you're applying into this one to lower expenses? There's got to be a reason for that discrepancy. And it's really the only true way to see past performance without, and to know that somebody's not just making up numbers and sending it to you. So it gives you a past and put it to their future. It gives you a lot of comfortability that they're going to continue performing like they have in the past.
Yeah. And I'm trying to think of a legal concern, because I've definitely had questions about disclosures or confidentiality. So you're really wanting identifiable properties that are not redacted. I mean, you could redact the EIN, redact the K1 schedules. You're not sending any K1s, but is there any issue with disclosing a tax return? I mean, I guess as an LP, do you have a confidentiality agreement? Are you signing NDAs prior to sharing this information?
Yeah, I would have no problem signing an NDA from the LP side of things. If they said, hey, we can give this to you, but I mean, you got to sign something that says you're not going to share this. You're not going to share even with a competitor, because they don't necessarily know, is this a competitor trying to see, what properties are doing in the area? There's a lot of different, avenues is what their concerns are,
I think if you're a GP, you have to assume that anything you email out is to a direct competitor. Mm-hmm. And as a policy, I mean, this is just me personally. I think every operator's competitive advantage is in how they do things, not a static piece of paper about the past, right? Because just because you show me Mark Cuban's tax return or you show me BlackRock's, portfolio, I can't replicate that. I can't create the relationships. I can't create the confidence or the capital to produce the exact same results as them, even if you gave me a blueprint, right? Just because you show me the plans, I can't build a house. Even if you give me all the materials and all the hammers and all the nails and everything. I just can't build it the same way.
And I would even be fine with a CPA's signature that, hey, these are, if you want to redact information, but hey, these are the numbers on a previous property, and the CPA signs it as the professional saying, I've reviewed these are correct. I did put these numbers together. You're just looking for some source of proof that this is legit. Somebody has to have real skin in the game, whether it's a CPA, whether it's sharing a tax return. You have to have a way to verify that these numbers are real. They're not just punched into an Excel sheet and put onto a pretty PDF and sent over to you. Because the reality is that if you get too far down the deal and you lose money, are there legal recourse options to get that money back? Of course, but they're not cheap. And if you only got $50,000 into this deal and that's your savings, you're never gonna be able to afford to try to get your money back.
Yeah, I even think for 250, for better for worse, it sounds unfortunate, but I consult with a lot of people. They still don't even want to throw good money after losing 250. At 400 to 500, I have represented clients, or we've worked with people to file lawsuits at 400 to 500K. And it takes some pretty blatant like fraud or some type of misrepresentation, and the GP has to have substantial assets. So it takes a lot of things, ducks in a row, not just the amount of equity, because even if you lose $1 million, if they did everything that they said they would and they just lost it, you don't have a good grounds for a lawsuit, and so you don't want to throw that money. But
or if there's no money to go get, if they don't have any money either, what are you gonna?
Right.
You're gonna have a judgment that they're gonna die with. You're never gonna see a penny of that money. So you spent a lot of money to get a piece of paper that says you're entitled to it.
That's right. That's right. Well, for better for worse, there are some people that will pay for that piece of paper, but everybody that's listening to this is not going to do that. They're not going to lose money. That's Warren Buffett's 101. Don't lose money. Rule number 2, C number 1. And so what we're teaching you here is very specific red flag checklist that you can go through one by one on a deal. And you need to get answers about all these things, because I agree. You said it earlier that this is merely a process to gauge how the GP responds. Almost none of the answers matter, because even if the tax return shows a 60% operating expense, it's okay if they're really on top of why. They show you a document and they say, we had to do this, and now on our new properties we learned that we never let pets in, and this area has massive St. Bernards, so we don't do that. What's another red flag that the answer doesn't matter, but you're listening to what they say?
I see sometimes too, a lot of time, I shouldn't say a lot of times, but sometimes, where they will have a sponsor who has a ton of assets under management, and they'll say, we have thousands and thousands of units, and they're using the data off of somebody who maybe has units across the United States. So a response would say, we charge $50 extra a month because of this, and that's based on data from thousands of units. But that may not be data based on actual performance in this specific area. So I would rather have somebody who has less units under management, but very specific knowledge and experience in an area. Something crazy like if you're in San Diego maybe, and you rent out lockers for surfboard storage, and you're getting $50 per month because that's a big clunky thing. They want a convenient place to put it. Well, that may be great data, but that doesn't mean I can rent out closet space in the Midwest for $50 per month, because if my client doesn't, or if my tenants don't have that same need and it doesn't hit them in the same way, they're not willing to spend money on it. So I could have 1 million closets available and project that I'm going to rent them out at $50 per month, but they don't have anything to put in there. I'm not going to rent out any closet. So I think that's a lot, is people will generalize and say, we rent out closet space as our example we're using. And it's like, well, in what area? For what? Why are people paying $50 per month? And then you get a response of either, I don't know, that's just what the data, or because we're in San Diego, nobody likes carrying a surfboard up 3 flights of stairs. So we put lockers on the bottom floor. It's super easy for them, makes it very convenient. Honestly, we sell them out. They'd probably pay more than $50 a month. Well, now I feel very confident that capital expense of putting lockers on the bottom floor is going to far outpace the cost of it. It's going to be very valuable, where that same person in Chicago is not going to have that. Maybe they do bikes or something, but it's going to be very area specific. And a lot of those types of answers, you want to hear the why behind the answer.
No, I think that's a great example. And what we see on the legal docs is, At the end of the day, I think you need a hyper local expert, but we do see on the legal docs that balance of, do you have a broad corporate umbrella that provides other strengths, right? Lender relationships, deep pockets, lots of resources in-house and strong vendor relationships. That's good for high level, but you also need the hyper local. And there's always trade-offs. If you're signing with a 2 to 3 man GP operation that does know the market and they own 2 or 3 or 4 other buildings, that's great. But understand that they're not going to have some of the in-house legal stuff, or they're not going to have in-house software that spits you out, instant investor relations reports. But it's a trade-off, and there is no red flag here except for a bad answer. And so I think, again, the best institutional or whatever you want to call them, national type of groups, they understand that. They talk about the resources that a national group gives them, but then individually they're hyper local. Maybe brokerage is like that too, right? You talk about CBRE or JLL, they've got national or international appeal, but at the end of the day, you're hiring a broker that does your market and very specific product type, or else you shouldn't hire them. You shouldn't hire the name just because they're a big national company.
Yeah, you see that sometimes. We're in the Midwest and I'll call up a broker and he's out in California or he's in New York selling a property in the Midwest. And it's just like, it doesn't really click. It doesn't make sense. I'm like, how do you know the details of this market? You're trying to apply national data to a localized market. And, on the GP side, that kind of gets exciting. Like, ooh, there might be something missed here that we know that somebody else doesn't. But that's a great point, is whether it's a small team or whether it's a big team, a big team will likely then have maybe a regional manager or a local person who really focuses on all the projects in that area to help answer those questions.
And that's who you want to be talking to. You want to talk to them to get their gut feeling. If you ask them, do you think we can really raise rents another 8%? If they hesitate, or if you have them on the phone and they say, well, yeah, I think so, I don't like that answer, as opposed to definitely there's no supply, or we're the best location, or this. You can gauge somebody's response, and you want to be talking to that hyper local person that knows those types of answers.
Yeah, and sometimes just a simple follow-up of, you seem pretty certain about that. What makes you so confident in that answer? And then you'll get the real truth, either the real confidence, or then you'll get the, like if they fall off of the planned script and you say, well, what makes you so confident? They don't really have that planned answer. And now you get the truth part of the brain to spit out. And hopefully the truth part matches the first part and they follow up with more detail. Well, here's why. And here's the details of why I'm so confident in that. And then you feel real good because now all right, this person actually has knowledge. And if I throw them back on their heels, they know how to respond because they truthfully have the experience in this.
And again, all of this as a red flag is a culmination of getting feedback, because even if they waver or they, drop down on some of the rent increases, if the deal still makes sense and there's reasonable AC fees and there's, reasonable this, and the sponsors know this stuff, even if their rent projections kind of come down a little bit when they fall apart under heavy grilling, if the expenses are still there and it's still a great asset and great, all this other things and good debt terms, all of that doesn't matter if there's a single red flag of, okay, their rent projection increases are a little bit optimistic, I'm going to underwrite lower, but it can still be a good deal. And I think that's what's important as we wrap up this video, which is there's no one red flag to me that would kill the deal, except, and maybe I'll ask you this, what's one red flag that kills it? But they're meant to be taken as a totality of the circumstances. And every deal, you'll find some reason to kill it, and you'll always probably find a reason to do a deal. And that's the challenge of being a passive LP investor, is you really have to make difficult decisions. So why not get as much data and good data as possible before making this $250,000 investment, instead of just relying on GP provided docs, which are never accurate. But I'll let you go. What is the one red flag that is absolutely a deal breaker for you that you couldn't recover from?
Oh man. So I can't say that. I think this is the big problem, right? Is everybody wants to look at it as scientific and data and tell me the one red flag. So I just always look at that one first. And I just don't think that's the case. I think the one red flag is to trust your instinct and your gut, because I think there's much more instinctual. I think your brain is seeing much more than you realize. And that gut feeling isn't just made up. There's something that was recognized that maybe you didn't consciously see, but there's a reason you feel that way. So I think that's kind of the purpose of what we're talking about. Is a lot of LPs want to look at just the financials, and they want to say this returns, 12%. This has this data point, and the person behind the deal is really what's going to make or break. Somebody who's dedicated and has a lot of skin in the game, or just not willing to lose, even if things go wrong, they're going to fight and they're going to dig in and make that deal work. There could be an outstanding deal on paper when you look at an Excel sheet, but if the person behind that deal isn't cut out for operating that deal, the best deal ever can go down the tubes very quickly. So a lot of this stuff is just trying to give your brain that, visual of seeing humans, seeing how they respond, getting a gut feel, because as much as we look at the data, and the data matters, we can't invest purposely in a bad deal. We're not trying to find a great person and a bad deal and hope they pull it off. We're trying to find both, right? A good person and a good deal. But so many focus just on the good deal, and they kind of forget about the good person or a good team behind the deal. So I think the biggest red flag for me is, and it's not a red flag, but the time when I say, no, I'm not moving forward, is when my gut just says something's off. I don't know what it is. I don't know why I feel this way, but I would much rather keep my $250,000 in my bank account and sleep well tonight than send my $250 out to work and have nightmares for the next week wondering if that was the right choice. And obviously that's a exaggerated example, but that is how it goes. When you have that gut feeling that doesn't feel right and you do it anyways, you're uneasy for a long time wondering, was that the right decision? You want to feel good about it. You want to send that money out and say, I feel very confident. Even if this deal doesn't work exactly how I planned, I feel really good that I'm making the right choice here.
Well, let me summarize my red flag, and it is built off of yours, but my one red flag that I would never invest with somebody is if you don't trust them. There has to be a very high level of trust, a fiduciary, whatever, a high level of trust. And it's kind of piggybacking off yours, but I kind of distill it into that red flag of, if you're on the fence, you don't trust somebody. You need to be able to say, I trust this person, because you're essentially wiring them the money. It's a blank check. They could peace out to Lebanon the next day and you never see them. So to me, eliminating that fraud or really bad intent in terms of the spectrum of possibilities is huge, because that's a zero, immediate zero and loss and never recovering. So taking that scenario off the table is huge. And I think it's just, do you trust this GP? That's a threshold. And if the answer is ever no, or is a middling answer, then that is no, if you have to hesitate. So that's my one red flag. I won't invest with other people. But thanks so much, Mike, for joining us. I think it was a very useful conversation about the process to get to your gut decision, not just the numbers. Numbers might look identical for 10 deals, but that way that they respond and handle those questions should really drive people, whether they feel comfortable to invest. So,
yeah, couldn't agree more, man.
If people want to reach out to you, or if they have more GP, LP questions about your deals, what's the best way to reach out?
Yeah, so our website is grandvision.co, not .com, .co. And then I'm on LinkedIn with most business stuff and conversation. And then Facebook is kind of my personal life. So if you want to get a feel and see who I am in the real world, that's on Facebook. If you just want to see the business side of things, that's on LinkedIn. But
awesome. Well, we'll drop links to all that in the description below. But thanks for watching, and we'll see you next time.